Hi, this is Brandon Bischoff. I'm Vice President of Portfolio Strategy here at Canterbury Investment Management. Today is May the 5th, 2020.
And I'm Tom Harden, Chief Investment Officer at Canterbury Investment Management.
And Tom, as you can see, it looks like we went with the whole baby boomer versus millennial thing where I wear a polo and you wore a suit.
Yeah, Brandon, back in the day, we used to wear suit and ties every day.
Yeah, well, the tie seems a little bit, sort of suffocating up here.
Actually, it is.
Yeah.
Anyway, there's an old saying that goes back way before Brandon, and that is, once you think you've found the key to the market, someone will always change the lock. And that's very true. Markets will tend to behave in a certain way for a number of years, and then they change. And when they change, it's usually for the opposite. To give you an example, if we go back during the 90s, from 1991 through 99, the market averaged about 21% a year, believe it or not. And $100 by the time you got to 2000 was worth about $5.50. And by the time we got to 2000, a lot of people thought, well, we'll never have another bear market. And then, of course, the market changed for the opposite. It was highly volatile. You had a 50% drop, an advance for 100%, another drop to 50%. So if we go from 2000 through 2009, $100 would have been worth about $70. And then when you least expect it, 2009, the market started shooting back up, and we generally have had a low volatile bull market up until a few months ago.
Yeah, and the transition to this new type of environment that we're in right now began with a series of anomalies. And these anomalies are unexpected, but you have to have a strategy in portfolio management for dealing with the unexpected. So we're going to be showing you a series of charts that kind of go through the start of these anomalies and what we've seen up to this point. And then we're going to go through the 4 different stages of adapting to this new volatile market environment. So here we have a chart of the S&P 500 index. This chart actually ends on February the 19th, 2020, which is actually a new all-time high for the market. And so if we're looking at this chart, you can see a series of blue lines with red hashes on them. The blue lines represent the high and the low for the day, and the red hash is actually where the market closed for that given day. Bottom half of the chart shows the Canterbury Volatility Index. As a general rule of thumb, anything below a volatility reading of 75 is considered to be, normal or stable volatility. As we've been discussing up to this point, when volatility gets really low, like it's heading toward extreme low levels here, you're more likely to see an outlier or even series of outlier days. We also talk about that in bull markets, anything from a drawdown from 8 to 12% is normal for a bull market correction. But moving forward here, we can actually see we get that normal correction very quickly. The market actually has a big volatility spike. That's a 3% down day, followed by another one, another 3% down day. And then 2 days later, we actually see a 4% down day, followed by a 4% up day, and then a retest of this level. So up through this point, we're actually at a normal correction of about 12% off of the market's high. So at this point, after seeing a volatility spike, we are in a transitional market state.
Right, and that's on a Friday, and again, it's a normal correction, and with this kind of volatility, sometimes you'll see it just kick right back and put in a new high without looking back. In that case, this happened. We saw a 7.6% drop on Monday. That is a total outlier of, should happen about once every billion years. And then from there, it just continues to go down. And again, from a portfolio management perspective, the concern is if we move to cash or put the defense on, you get a rebound, then you're not able to make that up.
Yeah, so like this is a 9% down day here. Well, I believe the next day is going to be a 9% up day.
Yes. And again, at this point, it's kind of irrational. What we need is for the market to put in a bottom, and then we'll expect a rebound back to about 50%, which we'll talk about in just a minute when we review a video that we did on the day of the bottom, which happens to be right here, the 23rd. At that point, the market's down 34%, and almost all of that happened within just a few days.
23 days 18 of those days were actually outlier days, or
Yes.
large swinging. So now we'll head over to that video where we're sitting at the bottom of the market and kind of what we went over on that day.
And we know again that when you get a parabolic decline, as scary even as this has been 22 days, but really if you go from that first gap, you're talking about 20 days, you're going to get a very, very sharp advance when you least expect it, because markets discount bad news quickly and they overreact to the downside. And again, over the last week or so, we've gotten an awful lot of bad news. That's a 32% drop in 22 days. According to a study done by Charles Schwab, the average bear market is about 39% and takes over a year and a half. So again, this is a trading anomaly, which is not the same as a normal bear market. These do get very strong kickbacks, rallies.
Yeah, it's like the stretching of a rubber band. You know, the further you stretch that rubber band down, the more likely it is to sort of snap back all
Right.
at once.
Exactly. And I think, again, whether you're using a strategic buy and hold and rebalance portfolio, or whether you're adaptive like we are, at this point, you really need to kind of hold the line. And then once we get this snapback rally, which is typically 40 to 50% of the entire decline, then you can make your adjustments and stabilize the portfolio. But this is a very dangerous period for individuals because your emotions are telling you to get out, and that's the absolute worst thing you can do. We know that all markets, again, they go back up, they put in new highs, but when you get this sharp of a drop, you will also get a sharp advance. And again, it becomes very counterintuitive. So this advance, this oversold rally, when it occurs, is going to happen fast. I mean, days, probably not weeks. And if you're not in, you will not be able to get in.
So, Brandon, we know from the studies that we've done that whenever you get a very sharp emotional advance, like a bubble, or a sharp decline like this, you get an equally strong move in the opposite direction. And that tends to happen when you least expect it. So we had talked about in the video that we would expect about a 50% or so advance off of wherever the bottom was. And we know now that that was the bottom on the 23rd. And right here is 50% at about 28.12 right here. And then we get a 9% update, 2, 3, 4, 5, and about 15 trading days, we're right there at a 50% rebound. Now, as we begin to get back into this area here, we can begin to put our inverse on. We begin stabilizing the portfolio because the most likely move from here is probably going to be a retest. I'm not saying that we're going to go back and retest the whole low, but again, this advance was as overreactive as what the decline was.
That's about 27% in 15 or so days.
27%, and then it actually goes higher. If we would have said it, you'd expect a 60% retracement. Right there you are. People would say you're probably crazy, and that happened in a very short period of time. And then as it stands right now, here's where we are. And we've stabilized the portfolio at this point. Again, after that big of a move over that short of a period of time, the most likely move from here and the most healthy move would be for this to pull back. If it pulls back at this point, our percent benefit of diversification is
about 75%. That's pretty much stabilized at that point.
So if the market dropped, 10, 15, 20%, we're going to drop just a fraction of that, and then we can begin to come off the bigger base, pull some of the inverse off,
and participate in those rallies and kind of get this ratchet effect going.
Exactly. So we're really looking at 4 stages here. We're looking at this first decline, which you have to kind of hold pretty much what you had. We could upgrade a little bit here. And then after we got this rebound, which we fully participated in, as we get back into this 40 to 50% range, we begin to really shift the portfolio to add the inverse and the alternatives. And at this point, we're stabilized. I don't care where the market goes from here. So this new market environment is going to be around for a while. And it started with a series of anomalies. Now, by definition, an anomaly is something that you don't expect, something that's very different. And this started with, 4, 7%, 8, 12% days. And this is volatility. These are outlier days like we haven't seen since
2008. And the difference between now and 2008 is that those anomalies or outlier days occurred in the middle or at the end of that bear market, not at the beginning coming out of a low volatility bullish environment. But that being said, with adaptive portfolio strategy, we have a process for dealing with this type of volatile environment. And it really comes in 4 stages. And so stage number 1 is, kind of what we saw coming off the market peak with those initial anomalies.
Right. So the first thing is when we saw the decline, you didn't know how far that was going to go. It ended up being 34% in a few days. And I'm not sure that that's ever happened before. But the first goal is not to get whipsawed, which means don't have more exposure on the way down and less exposure on the way back up. So now we know where the bottom, or at least a temporary bottom, is, and we did get our expected 50% rebound. And then at that point, as you said, we can begin to make the adjustments. That's stage 2, or actually going into stage 3.
Yeah, so as stage 2 occurs and you get that 40 to 50% retracement, stage 3 begins by adding on those more defensive positions, like inverse equities as an example. And then stage 3, we expect the market to remain volatile. The market's really weird right now. And
it is weird. And what happens is you don't see a 34% drop and a 30% advance in a few days, and all of a sudden see it go sideways.
Yeah.
So markets will tend to overreact in both directions. So the most likely direction from here is probably going to be down. The market has now been overbought for some period of time, but from our perspective, we've stabilized the portfolio. It really doesn't matter which way the market goes as long as it remains volatile. And if it's volatile, what will happen, we're stable. Each time the market drops, we have more cents on the dollar, and we come off a bigger base. And then the market, it's in effect what we would call the ratchet effect. This is the kind of environment that adaptive portfolio management really benefits from most.
Yeah, we don't know which direction the market's necessarily going to go, but we do expect it to remain volatile. And if it's volatile, this is an illustration of how we could potentially deal with and benefit from this type of environment.
So we'll be checking back with you again soon. This is an update of where you are right now, or where we are right now. And we will look forward to talking with you again soon.